Happy Friday, everyone, and welcome back to Your Finance TV. Fresh off of his Bloomberg appearance this morning, Jay Pelosky. How are you, Jay?
All right, Scott. Good to see you, buddy. How are you?
Great to see you. Now, I've had a quick look at your musings today, and you probably don't even know what a sugar glider is, do you?
A what?
A sugar glider.
A sugar glider. No, never heard the term.
A small little Australian animal, things jumps off of branches and so forth, and he gently flies down. And you could say that he has a glide path when he does do that, and that is the title of your musings this week.
It is indeed. And so we're all looking for the sugar. So, yes.
Run us through that title, glide path.
Yeah. We might have to get a video of your sugar.
Sugar glider?
Yeah, sugar glider for the video prep here. But yes, glide path is the title. And it really kind of came to me when I was going through stuff over the course of the week and noticing, particularly on FinTwit, all the people highlighting the number of soft landing stories and saying that it marks the top of the rally and everything is already in the price. And of course, I went back and looked, and Bloomberg notes that the peak in the soft landing references was actually back in August, so not over the last couple of weeks. And it reminded me that, let's think about the recession call, which existed for much of this year and a good part of last year, during which, particularly this year, in the first half of the year, the market was up considerably. So it suggests that we could have months of soft landing kind of stories ahead of us. And the question then becomes, obviously, how do markets react to that? And so, we didn't want to be left out here at TPW Advisory. We had to throw our own kind of title into the ring. And we suggested glide path because it does kind of comport with our outlook, right, which is pretty constructive, both into year end and then into 2024. Remember, a couple of weeks ago, we went through our 2024 outlook titled Surprise, Surprise. And a couple of those surprises were lower inflation sooner than expected. Arguably, that's already started to play out with the inflation number of October and the market reaction. And then secondarily, the move towards macro stability, right? And it's interesting, the Bloomberg hit this morning. Mohammed El-Arian was a guest anchor, and he's out with a new book titled Perma Crisis. And, so many people, really smart people, which is one, are fixated with this idea of perma crisis. Or over the summer, it was a Columbia University historian who put out a book called Poly Crisis, and all this idea of, crises. And, we have a different view, right? And our view is that we're approaching macro stability, and the market is already sniffing that out. When you look at a VIX that's under 15, when you look at a move index for treasuries that's under 120. And so as we put all this together, glide path seems to incorporate and encompass our point of view pretty well and pretty succinctly. And so it became the title of this week's musings.
And you did say, you've already mentioned that you're on Bloomberg TV this morning on the surveillance show. You went into a couple areas. Now, let's dig into those. In this format, we'll give you a little bit more time to talk about this, a little bit more time. So help the viewers out here, go a little bit deeper than you did this morning.
Sure. That's actually a great idea. And it's actually what we tend to do with our musings, right? When we go on, whether it's TV or do a video or whatnot, we prepare. And our preparation then becomes the basis for the musings. And that's the case for today. So we covered kind of two areas in the BTV hit this morning. One was the outlook into year end, and the second was our 2024 outlook. So the outlook into year end, as we see it, remains quite constructive. And we see four kind of pillars to that point of view. The first is seasonality, right, with November, December being the two best months of the year for the S&P. The second is sentiment. And until very, very recently, sentiment was very negative. Give you an illustration. State Street reported that at the end of October, institutional managers were very risk averse, just as an illustration. The third is positioning. And clearly we have hedge funds. Goldman's prime brokerage unit came out and noted that hedge funds have been increasing their net shorts for 14 weeks in a row up through last Friday. So it's very current, even incorporating the last couple of weeks. So up through the 10th of November, 14 straight weeks of hedge funds getting shorter and shorter. So that is positioning. And then the fourth is the technical outlook, right? And we've had multiple breadth thrusts, right? The story has been amongst the negative, the naysayers, oh, it's all 7 stocks. It's the Magnificent Seven. Well, the last couple of weeks have seen multiple days of massive breadth thrust, meaning the vast majority of stocks. I think we had at least one, if not 2 days of 90% up days, which are very, very rare and suggest, a lot of buying power. Obviously, if you're going to move 90% of the stocks in the market up in one direction. So, the way the story plays out, if those are the 4 factors, and the way I always learned it was that the more factors you have in pointing in the same direction, the more aggressive it allows you to be, right? Because you're not holding on to one strand or one thread. If you've got 4 legs to your stool, that stool is a pretty solid stool and you can put some weight on it. And so that's kind of what we've been doing in terms of adding to our model portfolio over the last couple of months. And we'll get into that in a minute. So we then we can talk about, and I'll finish up here on the outlook into year end. We can talk about kind of the 5 stages to this type of move, this type of rally. The first is that hedge funds cover, right? They're net short. They have to cover. Things are going against them. The second is hedge funds turn net long. The third is that the CTA community, which is a trend following community, they're completely off sides because they were following the trend of the last 3 months, right? Down, 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 3 months in a row. Only happened 8 times in the last 90 plus years. So CTA is completely off sides. Those institutional managers who have been holding a decent amount of cash, right, now underperforming, market ripping into year end. They know they're going to be their performance cuts at the end of the year, some at the end of November, some at the end of December. So there's a gate which they need to kind of get through. And so they start to buy, right? And then you have retail come in. And one of the groups, I forget exactly who, the research provider, noted that retail sold in October, so last month, they sold more stock in that month than they have in any other month over the last 2 years. So 2 years includes 2022 when markets were pretty ugly, right? So you had retail selling aggressively in October. So all that being said, things are set up very, very well in our view for a risk rally to continue through November and through December into 2024.
Well, we've done an earnings, a preview for 2024 before. And obviously everyone can go back and watch that. All the wonderful shows that we have here on Your Finance TV, especially from yourself, Jay. Now, let's just go back over them for people just catching this for the first time. What do you think are some of the prizes you can see for 2024?
Well, before we do that, I just note, looking at my notes here, that I should probably add 1 or 2 things to what we've observed over the last week or two, because they're pretty important. One of them is that people talk about that tech leadership, right? And our view is that tech leadership can sustain itself. And in fact, we added to US tech when we updated our model portfolios a couple of weeks ago. The other point that just occurred over the last few days, and I think is very important, is that the semiconductor space is breaking out to new all-time highs. And semis are the quintessential kind of early cycle because they go into everything, right? As we know nowadays, everything has a chip in it. So semiconductor stocks breaking out to new all-time highs is something we want to really pay attention to. And by the way, the bell cow for that sector, NVIDIA, reports early next week. So clearly there's a sense of optimism, people positioning a little bit in front of that. The other equally interesting kind of point from the technical side of things, looking at charts, as I did to prep myself for this morning's hit, is that the rest of the world is catching up to the US and is moving back above the 200-day resistance levels that have been a cap for ACWI US and for emerging markets over the last several months. So EM is now back above its 200-day resistance. And again, it's kind of validated by our models, right? Again, we run two models, our global multi-asset and our TPW20. Global multi-asset leadership over the last month or so has been concentrated in two segments: emerging markets, emerging market equity, and tech. And so that all this is kind of, coming together to support itself in ways that I think are pretty important. So that being said, let's talk quickly about 2024 and why we are constructive there. And remember, our focus was on surprises, right? The title was Surprise, Surprise, 4 macro surprises, right? The first being lower than expected inflation sooner than expected. And again, I believe with October's CPI print last week, we're already kind of getting a sense of that, right? Very constructive. And so we expect that to continue. Whether we look at used car prices, whether we look at rent falling, whether we look at gasoline prices falling at the pump, right? Crude fell 5% yesterday. So we are baking in, some most likely gasoline prices at the pump under $3. And that obviously does really good things for consumer confidence. It puts money in people's pockets. They're not spending it in gas. They can buy, more presents at Christmas time. So that's really constructive and we think sustainable. The second is a continued sustained productivity surge. And we had great numbers in Q3, some of the best productivity we've seen in years. And we think that can sustain itself based on the fact that companies learned how to do a lot with a little during COVID, as well as continued improvements via AI, starting to really penetrate if you pay attention to AI, as we do. We think it's a real theme, starting to really penetrate the workplace. And so you have productivity gains. And that leads into the third surprise, which is that macro stability, right? We think markets are sniffing it out. We talked about VIX, we talked about MOVE, but macro stability, even if we look geopolitically, right? Tons of worry about government shutdown. Didn't happen. Tons of concern about what's going on in the Middle East. Certainly a very difficult situation, but oil is falling during this period. And then we have what I think is very, very important, the relationship between the US and China. And here we had President Xi and President Biden meeting face to face. President Xi actually here in the United States for the first time in years. And that's very constructive. And on top of that, and this is getting a little wonky, but in Taiwan, which has elections coming up, it looks as if the coalition opposition is coming together to try and perhaps dampen the electoral chances of the pro-independence candidate. And so that arguably could cool things off in terms of China, Taiwan, and how the US might respond and all the other stories that people have. So that's the macro stability. And then finally, all of that together comes to pass in terms of, are we late cycle? In other words, about to go into recession, or are we early cycle, starting off a new growth period for the global economy? And I'll finish up here. There are a couple of points to mention, right? First is we are early cycle. We look at the semis, and that is very early cycle to us, very supportive. We look at housing, very supportive. We look at manufacturing. We believe at the cusp of a manufacturing recovery, also very supportive. And then we take a step back, and I noticed this in our looking at charts earlier this week. If you actually zoom out, Scott, and look over a couple of years, you note that markets have risk markets, equities, have basically done nothing for 2 years, right? The S&P is actually down on a 2-year view. The Qs, NASDAQ, down. The Magnificent Seven, most of them flat to up or down 5%. So to us, that suggests that the recession was in the first half of 22. The bear market was in 2022. And we are absorbing and digesting a lot of uncertainty over those 2 years, market sideways, basically no advance. And so we believe we're prepared as we get that macro stability, as inflation comes down, as the Fed feels comfortable cutting rates, as the dollar weakens. As a result, we've already seen that, right? Dollar off big over the course of this last week. That's really sets the stage for the rest of the world, sets the stage for that emerging market equity and debt play that we have on. We're now pretty heavily overweight across all of the tripolar world regions, whether it's Europe, whether it's Asia, whether it's the Americas. We have emerging market equity exposure in each of the 3 regions and are now significantly overweight equities. And we think that's really the area of opportunity. The big opportunity in a more stable world, in a world where the developed market central banks are done raising rates, ready to start cutting rates. The big opportunity is in the non-US markets, particularly the emerging markets. And that's where we've really, planted the flag, so to speak, in the portfolio for 2024, looking out 6 to 12 months. Emerging market debt and equity, we think, is really the opportunity set. Very, very cheap relative to the US and relative to their own history, as well as potential for growth as the central banks and EM start and continue to cut rates. We think we're on the cusp of an emerging market-led rate cutting cycle. That's going to really sustain growth, sustain equities, sustain risk appetite, and that's the opportunity set as we see it.
Well, Jay, listen, thank you so much for this breakdown on the musings. I'm going to send you over a picture of a sugar glider. But also, obviously, no musings next week with Thanksgiving. So you have a fantastic Thanksgiving and for you and your family.
Thank you very much. Yes, absolutely correct. No musings next week. It's going to be a short week. Looking forward to that. And you as well, Scott. Enjoy the holiday. We've got much to be thankful for, including hopefully a stable macro environment for risk assets in 2024.
Thanks very much, Jay. For everyone else out there, good luck investing.